Hello traders, Gary Wagner here. It is Thursday, approximately 10:30 a.m. in Honolulu, Hawaii, the 22nd day of September, and this is the Daily Report for Gold, and what a day we are witnessing. Once again across the board, but this time on a global span, we are witnessing stocks under pressure, currencies under pressure, precious metals under pressure, commodities under pressure. This global meltdown that we are witnessing currently is in response to, I believe, two major things. First of all, it's in response to the debt crisis that is going on in Europe. But more importantly, it is a statement made by the Federal Reserve yesterday. Yesterday, the Fed said, and I'm quoting, it saw significant downside risks in the economy. And that type of statement, most importantly, that type of language, using the word significant, is a very, very strong word for the Fed to use. And that's the reaction that we're seeing in the market. I recommended yesterday that we take our long position and we raise the stop pretty much to the market where it was, really risking about $10 on the trade. The trade was wrong. And even more, when I saw fundamentals change in the market, the economic climate change in the market, to not limit or cut any kind of losses that we had, we sustained roughly a $10 loss on this trade, but the market slid from 75 is now down roughly $35 lower than that, and I believe that there's a couple of areas we want to look at for potential bottoms, but I do not believe that we are there yet. But to not do anything, that would have been the big mistake. Now, we were looking at two different types of corrections, the triangle and the ABC. I was leaning towards the triangle, which is the flat top and ascending bottom. That was absolutely invalidated in yesterday's trading activity, and it is now quite clear that we are in a typical zigzag, or what's known as an ABC correction. As you can see here, I've still got that trend line. I will erase it now, but we were up to this point here. But when we broke, and I put up charts yesterday showing that we were just breaking below that, you can see that that break really carried this market lower and brought us down to these current lows right in the area of about 1730. Now, where could this market go? Once again, with a zigzag or a standard zigzag correction, you have basically three possibilities. You're truncated, which means that the C is going to have a low above this A here. That's the first. You're flat, and a flat correction would have an equal low. And then the last one is going to be what is a typical zigzag correction, in which what you are looking at on a more standard ABC is you get your A, your B, and in this case you had an irregular top, and then you get your C. This would be a standard zigzag, a flat, and then a truncated. What areas can we look for if in fact this market does find support? First of all, a flat correction would take us roughly to 1700. 1700, I believe the low was about 1703 on this particular A wave down. So that would be one possible area. Another possible area, of course, would be this 61% retracement. Now, that's a retracement from this move which started in July and really ended in terms of our traditional top right around the end of August. As you can see, this market moving up right around here. This was the high, but this was what I'm calling our wave 5, and giving up 61% would put us right to about 1650, and lo and behold, that gap would be filled. So traders, the first thing that I would do is put a price order in the market, good till canceled, for 1650. The second thing I would do is put a price order in the market for 1703. This is basis the cash or spot month, and we can go ahead and look at December later. And if in fact we have a what's called a truncated correction, and this is the top, and I personally don't, or the bottom, excuse me, I personally don't think that's what we're going to see. You might put a price order in here, but I believe that the best calls of action right now are to have a couple of price orders in here so that if we do get a continuation of this market, I believe we're going to find a bottom at some point, because now we have had a sizable sell-off. This sell-off in terms of percentages, this is, when we look at the big move, the 38 retracement. And again, this retracement is from the beginning of July to the top of this market. 38% puts you at 1750. We have breached those lows, but as you can see, we are still under pressure here. So we want to watch this very carefully. We might get some sort of a bottom activity that we see the market might drift as low as, say, 1700. It's come close to that. We're going to have to watch this market very carefully, but these are the two areas, traders, that I would put in price orders for. Traders, lastly, I want to take a look at the much bigger picture. This, of course, is a weekly chart in standard candlestick format. You can see the gap right here. And you can also see that from the beginning of this rally in July to the top that we've seen, we have roughly given up about 50%. This is an Andrews pitchfork, and we're currently below that 50% point, which is why the next real point I'm going to look at is 61% on the big picture, and that takes us and actually fills this particular gap. But the reason for bringing up this chart is to illustrate that we have had one of the most dramatic climbs in history as we witness this market here go from $600 an ounce to $1,900 an ounce. That's a $1,300 move, and $1,300 move since '08. That's tremendous. The fact that we're seeing this kind of a harsh and strong retracement in the big picture doesn't change my bullish outlook. I certainly believe at this point we are witnessing a correction and not a key reversal, meaning that we've gone from a overall bull market to a bear market. Are we in a bearish correction? Well, absolutely. But are we in a bear market in gold? My sentiment is no. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for the weekly review and wrap-up. Bye-bye.